TWR Tech Video. Before we get started, I want to highlight our next class and invite you to register today at traderswarroom.com/upcoming classes. We are going to teach you guys how to utilize economics and fundamentals to absolutely destroy the marketplace. Our instructor, Devin, is classically trained in both economics and financials, and this is going to be a fantastic class that goes way beyond just technical analysis. It's actually going to teach you guys how to look, read, and understand the fundamentals from a corporate perspective and a global economics perspective. This is absolutely a must-have class, especially in this current market. And on 19 March 2023 at 12 p.m. Central Standard Time, we are going to bring you this class live via Zoom. $15 gets you a seat, and every purchase gets a recording. Sign up today, and I'll see you there. Today's tech video, we're going to cover what is a bank failure, why do banks fail, and we're going to give you definition, causes, results, and some examples. So put simply, a bank failure is closing of an insolvent bank by a federal or state regulator. The comptroller of the currency has the power to close national banks. Banking commissioners in the respective states close state-chartered banks, and banks close when they are unable to meet their obligations to depositors and others. When a bank fails, the Federal Deposit Insurance Corporation, or FDIC, covers the insured portion of a depositor's balance, including money market accounts. The FDIC will insure up to $250,000 per account, and anything over that is considered uninsured funds. Note that the wealthy do have other means of protection, but normal peeps like you and I, and small businesses and corporations are just SOL. So understanding bank failures, a bank fails when it can't meet its financial obligations to creditors and depositors. This could occur because the bank in question has become insolvent or because it no longer has enough liquid assets to fulfill its payment obligations. Now, there are many reasons why these banks fail and this type of situation happens. However, it's because the bank loses too much on its investments too quickly. And I want to highlight this, okay? It is not always possible to predict when a bank will fail, as we saw with the SVB. No one saw this one coming, and when they happen very quickly and very dramatically. On that subject, so SVB, right? Think of that when we go over this. When a bank fails, it may try to borrow money from other solvent banks in order to pay its depositors. If the failing bank cannot pay its depositors, a bank panic might ensue in which depositors run on the bank in an attempt to get their money back. And this can make the situation worse for the failing bank by shrinking its liquid assets as depositors withdraw cash from the bank. And in one of our examples, we'll go over SVB, but pretty much what I just stated is what happened with SVB and how it rapidly declined so quickly. Let's talk about the FDIC a little bit. Since the creation of the FDIC, the federal government has insured bank deposits up to $250,000 in the U.S. When a bank fails, the FDIC takes the reins and will either sell the failed bank to a more solvent bank or take over the operation of the bank itself. Ideally, depositors who have money in the failed bank will experience no change in their experience of using the bank. They'll still have access to their money, and they should be able to use their debit cards and checks as normal. They just may not have as much money to use since FDIC only insures up to $250,000. In the event that a failed bank is sold to another bank, account holders automatically become customers of the new bank and may receive new checks and new debit cards. This popular type of term is known as mergers and acquisitions. I'm sure you guys have all heard of that, and we've seen plenty of banks in the recent history go through this type of process. Some of the ones that you might remember are coming up here shortly. Washington Mutual is the biggest bank failure in U.S. history, and it occurred between 2007 and 2008 financial crisis. $307 billion in assets, and the bank closed its doors. And guess who picked it up? JP Morgan and Chase. And that was the catalyst to them just exploding to one of the top tier banks in America. Another large bank failure had occurred just a few months earlier before the big one, and this was Indy Mac, and it was seized and it became One West and then First Citizen. The third all-time largest closure was a $34 billion failure of Continental Illinois in 1984, and was then bought by the banking juggernaut we know today, Bank of America. And here we go. Recently, the SVB that just happened this past week, over $200 billion in assets, and has a ripple effect that expected to hit tech startups and Silicon Valley heavy companies. The FDIC maintains an up-to-date list of all failed banks on its website. Definitely worth a read, and there are quite a few names there that, we see this happen with banks over and over, but these big ones that fail with the billions of dollars of assets, these don't happen all the time. So the FDIC, this was created in 1933 by the Banking Act, often referred to as the Glass-Steagall Act. In the 9 years immediately prior to this happening, which marked the beginning of the Great Depression, 1/3 of all American banks failed. During the 1920s, before Black Tuesday crash of 1929, an average of about 70 banks had failed each year nationwide. During the first 10 months of the Great Depression, 744 banks failed, and during 1933 alone, 4,000 American banks failed. By the time the FDIC was created, American depositors had lost $140 billion due to bank failures, and without federal deposit insurance protecting those deposits, bank customers had no way of getting their money back. Not at all. No $250,000 protection, no $5 protection. Once the money was gone, it was gone. SVB was shut down by regulators on Friday, March 10th in the largest bank failure since the 2008 financial crisis that we talked about earlier. This had over $209 billion in assets, and at the end of 2022 was when they reported. Bank failures can come from various causes: fraud, bad lending, or mismatched of assets and liabilities. And it appears from the research that's coming out, and obviously this is evolving as we go on because it's still rather new, that the asset liability mismatch was behind this particular bank's issue with their collapse. Now we need to understand, how do banks operate, right? Okay, so a bank takes in deposits from customers who could be individuals or businesses. Then it invests most of those deposits in loans or securities, but keeps some cash on reserve for when a depositor wants its money back. Okay, we kind of understand, right? We put the money in the bank uses money to make money and give us percentages of the money that they're utilizing to make us money in the end, right? Because they're betting on the idea that we're not going to pull our money all at once. Now, how is SVB different, right? So the Silicon Valley Bank was not your typical bank, which by itself is not any type of criticism on the bank, right? But most of the deposits come from large companies that were part of the tech sector boom. You could see some of the ones down there that are in this, right? So a lot of these venture capitals and these tech startups that are very popular today in this tech boom or this tech bubble were clients of SVB. An example of this would be a startup receives $100 million from a venture capital fund, right? It parks that money at a local bank like SVB. Another company might have a treasurer who gets the best possible short-term interest rate by investing in commercial paper or other financial instruments. But the startup's CFO is not hired to nurse an extra 5 basis points from the cash holding, right? So the CFO has a bigger issues to deal with than a few staff members to help, right? So the CFO, they'll utilize a bank like SVB for their particular money management. So basically, the bank recognizes that this deposit base requires liquidity, right? Most banks put the bulk of their assets into loans, but some banks have small depositors who won't need their money suddenly. That's what the gamble is. You won't need your money suddenly. Now, this is all good, but when people come in large groves and they need their money suddenly and it's big amounts of money, this is when you have issues. So SVB, right, put most of their assets into U.S. Treasury securities, which there's no credit risk because it sounds safe, because it's low, it's low volatility, low, market expectations and stuff like that. So they look at it as a safe bet. Unfortunately, the best yields are usually found on long-term bonds rather than short-term bills. Now, the problem with the long-term bonds is that when interest rates rise, the value of old bonds that still pay the old interest rate goes down. The Silicon Valley Bank parent company, SVP Financial Corp, reported at year end in 2022 that its bonds were worth $117 billion, but had been purchased for $127 billion. You can see how much they had depreciated over time, and the value calculation edged south as interest rates rose. The 10-year Treasury yield, for example, closed the year at 3.88, but hit 4.08 in early March. The rise in the interest rates created an even larger loss for the bank. Still, the publicly available financials suggest that the bank, we're talking to SVB here, was still solvent when it was closed. Solvent, but in trouble. And as I said, news is coming out every minute, every day, and we'll find out when they do their investigation on what exactly is going on and if people are going to be able to get their money now. But this is trouble, okay? This is big trouble. When you can't go to the bank and get your money, there's an issue. And here we go. The trouble came from corporate depositors. FDIC insurance only covers depositors up to $250,000. A corporation with $100 million in deposits in just an unsecured creditor. And it's easy for a company to move its money from one bank to another, or to buy treasury bills or commercial paper. So when it appeared that the corporation depositors, that Silicon Valley Bank, was in trouble, the smart and easy response was to take your money out. There lied the issue, because as more money left the bank, it probably had to sell off securities. At some point, the bank would be left with liquidity assets, loans, leases, bank premises, and equipment. And those particular assets have real value but cannot be converted into cash as quickly, meaning that some depositors would not be able to get their money immediately. That's when the big issue happens and the panic happens. So lessons learned, right, from this bank failure apply to many companies, not just banks, right? So first, understanding liabilities, especially how quickly creditors can demand repayment. Second, understanding how quickly assets can be converted into cash to meet the creditor's demand. And third, recognize the long-term assets usually lose market value when interest rates rise. So as a result, danger lies in borrowing short-term to long end goals, right? Bankers have learned this lesson before, and I've showed you examples time and time again where this happens. But as the great sailor Bernard Moitessier once said, the best lessons in life must be learned many times, over and over and over again. And unfortunately, some people have to pay the piper. So with that said, let's kind of talk about a doom and gloom approach, but potentially a buying opportunity, right? So investors brace for a crippling liquidity crisis, unleashing a brutal sell-off that left SVB, reeling from its worst beating in recent memory, right? So as SVB closed yesterday's trading and battered TTM books value per share of 0.5x, some investors might see this as an opportunity that they've been waiting for. However, a failure should not be ruled out, as a massive loss of confidence could cause valuation to crumble even further. So sometimes in crisis, opportunity comes knocking, right? So this potential means reversion opportunity looks attractive for patient investors with nerves of steel for tolerating that volatility. Investors who wanted to sell have likely sold out, right? Hence, those still holding the ball probably expect some turnaround that could see the bank and its stock survive its worst crisis since 2008. So when we look at the chart at a closer inspection, suggests that a bear trap or false downside breakdown could be occurring. However, tremendous patience is required, and the signal has not been validated at this point. It could continue to go down. I mean, we've seen this thing as it closed on Friday at 39 bucks or something like that, because it was halted all day because of the news. Now, I got this chart from XLF, right, which gives you an understanding of the financial crisis back in the day, okay? So, notably, a massive bear trap occurred in March 2009 after the rapid hammering over 5 months from September '08 during the financial crisis. And you can see that right there in this arrow. Boom, right? Dump city. But look what happened. As soon as the tides kind of settled and you were down at this low point, this 379 area, we had some consolidation for a while. And then you saw a dramatic uproar, just catapulting from the bottom. This is what some investors that are a little more risky and have some nerves and see a bounce, type of idea here might be getting invested, especially if this particular stock is bought out and it stays publicly and it stays on the market. Now, here's SVB, right? This is March 2020 lows. We believe that the selling pressure could subside relatively to yesterday's sell-off after the post-market reaction. Note that this is the quarter chart and it's a lot lower than what's showing on this one right now. So here's basically how SVB closed on Friday, and it was halted all day, right? But we're looking at like 39 bucks. Volatility should be expected as some investors go at the sell first knee-jerk reaction and ask questions later, right? And that's okay. They're protecting their money. However, if SVB could survive this, the attractive risk versus reward valuation supported by potential constructive price action could bolster its recovery. And right there, I don't think that we see a huge bounce anytime back going into like the 200s or things. And I don't see we hit like into the hundreds anytime soon until these waters are settled. But a bounce with enough investor support coming in, as long as it stays public, and if the stock still opens, you could definitely see this coming back up and seeing some of that volatility while it's making its move and it's kind of going within range of, like, I think about $141 is where I put a nice little tick mark for a high level at. So no surprise here, right? Opportunities knocking. Elon Musk wants in. So Elon Musk says he's open to the idea of Twitter buying the SVB bank. And it's abruptly failed on Friday, leaving many worried this weekend about what ramifications might unfold, not just with SVB, but with the economy and with the other banking sectors as well. So the billionaire responded Friday night to a suggestion that Twitter should buy the SVB and become a digital bank, which is something that Twitter has wanted to do for a while to give them a financial leg on their investment with Twitter. Now, this isn't just one of those ideas that Musk came up with. He's actually getting a lot of support, right? There's others that are giving him support. I think Twitter could utilize a financial leg. And this came from Palo, right? And another person said it would make total sense for the entire Musk ecosystem to buy the ruins of SVB and could create a viable business model going forward for Twitter. And then another person said, well, an opportunity by Kevin Praith. So once again, this opportunity comes knocking, and if you have the capital, the wealthy are usually the ones that are able to come knock. But this would be something that someone like a Musk could come in and swoop up and take this upon themselves, or another bank like we saw JP Morgan and Chase, Bank of America. Maybe it's time for Goldman Sachs to come in, maybe Morgan Stanley, who knows, right? But Elon Musk has done this before, right? He helped launch PayPal, then took over Twitter. And so he aims to add payments to the platform, which an acquisition of SVB would presumably help that in the right direction. Buying Twitter is an accelerant to creating X, the Everything app he tweeted earlier this month. It gives an idea that this opportunity doesn't happen all the time, and when it happens, you pounce, and you pounce hard. The idea would basically, Twitter would become kind of what China has in WeChat. It offers an example of this app where payments, in addition to messaging, streaming, video chats, and other things. And that's kind of what Twitter's trying to go through, that everything type of app. Twitter has been applying for regulatory licenses and creating software to introduce payments on the platform. And this acquisition of SVB, which absolutely sounds very plausible and a smart move, could make this a quicker reality. So in conclusion, right, bank closings aren't uncommon. And I've showed you plenty of mergers and acquisitions that happen quite often with the banking sector. However, what impacts hugely with bank failures are when they are either over leveraged or their money from depositors are tied up in speculative ventures. Imagine having your life savings in a bank or being an owner of a small startup and having zero access to your money with only $250,000 guaranteed as secured. That's pretty scary to think of. Unless you're keeping your money stuffed in a mattress, this just isn't part of the business, unfortunately. But once again, this is more reason to truly understand the fundamentals and business economics of what your bank and things that you're investing in are doing. Gone are the days that you can blindly trust the businesses will do right by you, the consumer. Nothing is too big to fail, and you need to be educated and you need to get spun up right now. This was one of the reasons why we created our class on 19 March 2023. We want our members in our community to not only be technically sound, but fundamentally sound with clear understanding, or at least the basics of how money works in both business aspects and economy aspects, and then correlate that into how we can utilize that in our trading and investing journey to absolutely destroy the market. All right, team, that's all I got for you guys. Just a quick reminder, don't forget to register today for our next class. You go to traderswarroom.com/upcoming classes, sign up for the economics and fundamentals class, and I will see you there. This is a class that is so vital. As this tech video just explained, you got to have a clear understanding of what corporations are doing, how they're funded, and also not just funded on an individual spectrum, but also how they work into the global markets as well. This is a must-have type of class to complement your technical analysis when you're looking at investing and trading. And I hope to see you all there on 19 March 2023 at 12 p.m. Central Standard Time. $15 gets you a seat, and every purchase gets a recording. I'll see you there. And as always, make the market bend the knee in 2023. Join TWR and bow to no one. The link is in the description or on the website at traderswarroom.com. Let's go to war.